Hello everybody, welcome. I'm Nicola James, Co-Head of Global Sovereign Relations. I'm here today with two of my colleagues, Yasin Arwazi in the Sovereign team and Amaury Boudouin in the European Corporate Credit team. So we're going to do a couple of presentations and then we'll answer some questions.
Good afternoon, everybody. My name is Yasin Arwazi and I work as a sovereign analyst at DBS Morningstar. Today, I will speak about energy challenges of the German manufacturing sector. The German manufacturing sector continues to be exposed to substantial energy challenges. Although energy prices have decreased over the past month, they are unlikely to go back to their pre-crisis levels over the next years. And my presentation today starts by highlighting some factors which are likely to keep energy prices elevated in Germany over the next few years, and then I will focus on how high for longer energy prices are likely to impact the manufacturing sector, and I will highlight which manufacturing industries are particularly vulnerable to such an energy price shock. And later, Amaury will discuss the energy challenges for selected manufacturing companies. The manufacturing sector is a major consumer of energy in Germany. Over the past year, it accounted for around 36% of total gas consumption and around 43% of electricity consumption. In addition, as we all know, the manufacturing sector is a crucial sector of the German economy. It generates around 20% of gross value added and accounts also for around 20% of total employment. Therefore, any potential scaling effects from high for longer energy prices on the manufacturing sector are likely to have a noticeable impact on the German economy as a whole. When talking about the impact of higher energy prices on the manufacturing sector, it's very important to distinguish between recent short-term developments and the medium-term outlook for energy prices. The short-term outlook for manufacturing industries has certainly improved over the past few months. Gas and electricity prices have receded from their record highs last summer. Furthermore, downside risks for the manufacturing sector, like a rationing of gas, have not materialized over the past winter due to high gas storage levels. Nevertheless, a return of gas and electricity prices to pre-crisis levels is very unlikely over the medium term. Moreover, the gap between energy prices in Europe and other major economies like the US has increased. This rising divergence of energy prices in Europe and other major economies like the US might weaken the international price competitiveness, particularly of those German manufacturing companies which compete in global markets. The increase in European energy prices started in summer 2021 and was aggravated by the war in Ukraine. Current prices of energy futures do not indicate a return of European gas and electricity prices to pre-crisis levels over the next years. Gas futures currently indicate that gas prices over the next years will be more than twice as high than prior to the energy price shock. Electricity prices are projected to be more than 3 times as high as before. In terms of gas, higher gas prices can be attributed to a higher reliance of the German economy on liquefied natural gas or LNG. Imports of LNG are more costly than imports of natural gas through pipelines due to higher transportation and transformation costs. In future, Germany will rely to a larger extent on imports of LNG since imports of Russian pipeline gas are very unlikely to return to anywhere near their pre-crisis levels. The increase in gas prices has also led to upward pressure on electricity prices. Natural gas is an important source of electricity production in Germany, particularly during times of low electricity production from renewables. Furthermore, electricity production in Europe has been hit by multiple shocks over the past year. We saw a sharp decrease in nuclear power production in France. Furthermore, Europe experienced a strong drought last year, which lowered hydropower production in several European countries. Going forward, there's substantial uncertainty about whether the European nuclear and hydropower electricity production capacity levels rebound fastly from the recent hit. There's also substantial uncertainty over the pace of capacity additions in renewable energy. Several European governments have announced ambitious expansion targets for renewable energy. However, it is quite unclear if governments will actually achieve these targets. This applies particularly to Germany. The German government has set out a very ambitious expansion target for renewable electricity production. It seeks to raise the share of renewables in national electricity production to around 80% in 2030, up from 44% last year. This strong expansion of renewable electricity production capacities is a very important policy task for two important reasons. First, electricity demand is projected to increase markedly over the next decade due to the electrification of the economy. And second, on the supply side, electricity production from other energy sources is planned to decline. The government plans to decommission the country's 3 remaining nuclear plants in April this year and to phase out coal-fired power plants until 2030. Therefore, renewable energy production needs to fill the gap. In what follows, I will assess how high for longer energy prices will impact the manufacturing sector. I will assess the vulnerability of different industries from 2 different angles. First, I will look into the distribution of energy consumption across industries and highlight the main energy-intensive industries. And second, I will look into whether these energy-intensive industries are exposed to strong global competition. A high exposure to global competition will limit an industry's ability to pass on higher energy input costs to their customers. On this slide, you can see the distribution of gas and electricity consumption across German manufacturing industries. It shows the shares of the main industries at total manufacturing gas and electricity consumption in 2021. The largest consumers are displayed at the top of the chart. This slide clearly shows that gas and electricity consumption in the German manufacturing sector are distributed in a very uneven manner. They are heavily skewed towards certain energy-intensive industries. The largest industrial energy consumer by far is the chemical industry. Gas in the chemical industry is utilized both for high-temperature heating processes and also as a feedstock for the production of certain products like fertilizers, for example. The second and third largest energy consumers are the food industry and the production of basic metals. The chemical, the food, and the metal industries account for around 60% of total gas and around 50% of total electricity consumption. At the same time, however, they generate only around 19% of total manufacturing gross value added. It's also important to note that the energy consumption levels of the 2 largest manufacturing industries in Germany are considerably lower. The 2 largest manufacturing industries in Germany are the automotive industry and the production of machinery and equipment. These 2 industries can be found in the lower half of this chart, as production in these industries is less energy intensive. Therefore, high for longer energy prices will hit these 2 industries less than the chemical industry. The chemical industry is not only a large consumer of energy, it is also exposed to strong global competition. Industries which are exposed to strong global competition will find it more difficult to pass on higher energy input costs to their customers. This applies particularly in case there's a substantial divergence of energy prices across major economies. In contrast, industries which operate in a less integrated market are likely to have more leeway to pass on higher energy input costs to their customers. To get a better sense of the exposure of different industries to global competition, we have measured the shares of non-euro area sales at total sales for the major manufacturing industries in Germany. We focus on non-euro area markets since European energy markets are closely integrated. Therefore, manufacturing companies across Europe are likely to face similar energy input costs. This scatter plot visualizes the vulnerability of different manufacturing industries to an energy price shock. On the vertical axis, you see the shares of manufacturing energy consumption. The industries which are displayed on the top of the chart are the main energy consumers. The horizontal axis displays the share of non-euro area sales at total sales for different industries. The industries on the right-hand side of the chart are more dependent on non-euro area markets. That means the most vulnerable industries can be found in the top right corner of the chart. The size of different industries is displayed by the bubbles. The bubbles measure the share of a particular industry at total gross value added in the manufacturing sector. Hence, bigger bubbles mean bigger industries. The chart clearly singles out the chemical industry and to a lesser extent basic metals as the most vulnerable industries. The chemical industry has very high energy consumption levels and depends on non-euro area markets. This depends on non-European markets is much less the case for other energy-intensive industries. For example, the food industry, which is also a very energy-intensive industry, is displayed on the left-hand side of the chart. It depends much less on non-European markets than the chemical industry. This might be ascribed to high transportation costs in the food industry, and therefore the food industry has a higher leeway to pass on higher energy input costs to their customers. Wrapping up, I think it's important to point out that for longer energy prices will impact the manufacturing sector in a very asymmetric manner. There will be no uniform impact. There won't be widespread deindustrialization, but certain industries are likely to be hit markedly. Our highest vulnerability to an energy price shock has this. It's very energy intensive and operates in global markets. It accounts for around 8% of total gross value added in the manufacturing sector. In contrast, the two largest sectors, automotive and machinery equipment, which together account for 33% of gross value added, have a much lower vulnerability to an energy price shock. Future energy prices will certainly have an impact on these two industries, but they are unlikely to be the major driver of future development. I think the future development of automotive and machinery equipment will rather be driven by other secular trends. For example, in case of the automotive industry, the switch from internal combustion engines to electric engines comes to mind. In case of machinery and equipment, automation will be a key driver. The overall size of potential scaling effects will obviously depend heavily on the future development of energy prices. Based on energy prices in late 2022, the Bundesbank estimates high for longer energy prices to dampen gross value added in Germany's industry by around 4.5% on a permanent basis. This is clearly a noticeable detrimental impact on the manufacturing sector as a whole. But again, this kind of energy shock is very unlikely to lead to widespread deindustrialization. In terms of economic policy, any efforts by the government to minimize potential scaling effects in the manufacturing sector should really focus on expanding renewable energy production capacities. This would help lower electricity prices. I leave it there and hand over to Amaury.
Thank you, Yesen. Over the next few slides, I will focus on the corporate impact, the impact on the corporate sector in Germany of high energy prices and in particular natural gas. Just a bit of context to start with. Germany targeted gas consumption reduction of at least 20% to ensure supply security and also in preparation for next winter, so winter 23 and 24. And it looks like so far this past winter, the consumption reduction has been less than 20%. It's been around 15%. And it's owing to slightly warmer than average temperature. And also obviously the fact that, now we have high storage coming out of the winter, and it's obviously driven also by the 15% reduction. For the next winter, the situation will be very different because as opposed to 2022, in 2023 there is no gas coming from Russia, and also there is a lot more competition for from China, from the economy in China reopening for all the LNG. So it's a very different picture in 2023 than in 2022, where we had Russian gas flowing up until about halfway through the year. And the Chinese economy was still on lockdown due to the COVID-19 pandemic. So as Yesen mentioned earlier, the chemical sector in Germany is one that's facing the toughest challenges. There is a number of manufacturing sector in Germany is famous for its Mittelstand and its manufacturing sector, but the chemical sector is the one that's the most impacted. The chemical sector relies a lot on gas, both for feedstock and as a power source. So it's extremely difficult to replace natural gas as a feedstock. However, in terms of natural gas as a power source, in the long run, there are options, and there's a possibility to rely less and less on natural gas and rely more and more on renewable energy or on coal. In the example of Germany. But as a bit of context, Germany used to import about 55% of its natural gas from Russia, and as of last year was the third largest chemical exporter. So this particular industry, the chemical industry, is heavily impacted, and it has a huge impact as well on the overall German economy. So last year, a lot of German companies taking some steps in order to mitigate the impact of high prices, and this has included, for example, replacing natural gas with other sources of energy like biomass. Relying more on renewable. There's also the additional import of LNG, which is taking time to ramp up, but it's going to be an important factor in reducing the gap and replacing the Russian gas. The chemical sector is also a very commodity-like sector. It's exposed to global competition. So, the European sector is at a disadvantage compared to the US, for example, where the supply of natural gas over there is plentiful and it's also much cheaper. So the European chemical sector, and in particular the German one, is at a disadvantage compared to the US, for example. If you look at the financial impact of high natural gas prices is starting to be visible. And if you look at some of the market leaders, which we've highlighted here on this slide, you can see that those market leaders have been able to use the pricing power and increase prices, which has led to an increase in revenues. So you can see on this chart here, which is on the last 12 months basis, that they've almost all been able to increase prices, increase the revenue. But if you look at the EBITDA, it's a much different picture, and you can see the EBITDA margin has been actually decreasing quite substantially in some cases, quite dramatically in the case of BASF and Covestro, for example. And that's just a function of the fact that they're not able to pass on all of the increased costs, and the increase in natural gas prices and energy prices in general has just been too large for them to be able to compensate that through increased prices. So obviously we've only highlighted a few market leaders here, but You can imagine that the picture is probably similar, if not even more drastic. If you think about small to mid-sized companies known as the Mittelstand in Germany, and also companies that lack diversification, that are exposed to one single or maybe a couple of different products. All the companies here that we highlighted in the table are relatively diversified, both in terms of the locations, where they produce, where they sell, and also what they sell. So they are able to reallocate resources, and obviously they will probably be able to weather the energy price shock. But it's probably a very different picture for smaller players. And just a few final thoughts. So gas rationing is still very much a possibility for next winter because, as I mentioned earlier, there is a lot more competition from Asia, in particular for the imports of LNG, and it's extremely difficult to predict the weather. So next winter could be colder than average, which obviously would lead to a depletion of the storage faster than we saw in 2022, 2023. So this is an important factor because structurally nothing has really changed. There are some LNG terminals that are being ramped up in northern Germany to allocate and to allow for more imports of LNG into the country, but it's not going to fill the gap. There is obviously the ramp up of renewable, which is taking time, and is where Europe and Germany they need to install more of this capacity. So that's also one avenue for filling the gap, but it's taking time. It looks like natural gas prices will still stay elevated, although they've receded from their very high levels that we saw in 2022. But we're still expecting natural gas prices in Europe to be way above the levels that we saw before COVID and before the invasion of Ukraine. And so the longer those prices stay high, the more it will eat into the profits of a lot of German companies, in particular chemical companies. So a lot of them will be forced to allocate resources somewhere else, shut down production entirely, and relocate production to other geographies where resources are cheaper. So, for example, we can take the example of Evonik and Covestro, two leading German chemical companies, and they've warned that profits in 2023 will be lower than in 2022, and that's already on 2022 profits that were lower than in 2021. So the situation is becoming, quite I wouldn't say dramatic, but it's becoming more concerning. Obviously, those companies are leaders in those sectors, so they will be able to somewhat come out of the crisis in a relatively strong financial footing. But there's a lot of smaller Mittelstand companies that will be forced to shut down and won't necessarily be able to survive like the leaders will. We can think about one of the most prominent examples, which is BASF, which has announced relocation of some of the capacity that they have in Ludwigshafen, one of the largest plants in Germany, to a large plant in China. So that's one of the examples, as well as companies are considering moving and shifting away some of the production into geographies where natural gas is cheaper. It is also expected that the German government will continue to support its manufacturing sector, considering their relatively large fiscal capacity and also the high importance of the manufacturing sector, the chemical sector as a whole for the economy. The latest example is the German price break, which will provide some relief to the industrial sector and the households, but it won't fix the issues in the long term in terms of structural issues that Germany has, and which is essentially the heavy reliance on Russian gas and the lack of alternative supply, at least in the near term. So there is a real need for alternative energy sources into Germany. And obviously there's a lot that's going on in terms of LNG, more capacity for LNG imports and renewable. But in the short term, next winter is probably the one that we will be waiting for, and hopefully storage levels will be high, and maybe the weather will play in our favor, and also the demand will be reduced accordingly. So there's still a lot of uncertainty. So this concludes the presentation slides that we had, and we will open it for Q&A now.
I have some questions to start. First for Jessen. Has the recent energy price shock already impacted production patterns in the German manufacturing sector?
Yes, the impact has clearly been visible for the chemicals industry. Production levels in the chemicals industry have decreased markedly over the past year. In January this year, the chemical production levels were down by around 20% compared to January 22. And I think this clearly shows that chemical production is very sensitive to energy price development. And in addition, I think the production development across the manufacturing sector over the past year also show that higher energy prices do not impact different industries in a similar manner. On the one hand, as I just said, production levels in the chemical sector decreased markedly. On the other hand, some industries saw production increases as they still benefited from higher order backlogs. For example, the two main sectors in German manufacturing, the two main industries in the German manufacturing sector, automotive and machinery and equipment, saw production increases. Therefore, I think, production patterns also show the asymmetric impact of this energy price shock.
And another question for Jessen. Given the recent financial market volatility, any evidence of a credit crunch emerging here in Germany, and could this impact manufacturing companies?
So far, there's no evidence of a credit crunch in the financial data. The last available observation dates back to January 23, and in January 23, new loans to corporates rose by around 26% on a year-on-year basis. I mean, obviously, this data is published with a time lag, so if global financial volatility increases further, we might well see much lower credit growth in future, and a lower availability of credit is likely to impact certain manufacturing companies. At the same time, I think it's important to note that the indebtedness of the corporate sector in Germany is lower than in most other European countries. Therefore, that's certainly important mitigant in this regard.
And now for Anne-Marie. What are the main drawbacks of LNG versus natural gas transported by pipeline?
Well, one of the main drawbacks of LNG is it's more costly, and it needs to come from far away. So there is also transportation costs that need to be taken into account. So it's costly, and then it needs to be transformed and imported through certain terminals. So it's a little less flexible than, let's say, natural gas that can flow through pipelines, and in particular the natural gas that used to flow from Russia. There's also an important thing as well in terms of geography. A lot of the gas that was obviously coming from Russia used to flow in pipelines in an east to west direction, with the exception of some pipelines coming from northern Germany, for example. But from a European standpoint, the pipelines were kind of set up in a way that it would accommodate all the flow coming from Russia. So shifting to LNG is not only costlier, but also a little less flexible. On top of the fact that it won't be filling the gap that left by the lack of Russian gas. So it is definitely helping, but it has some disadvantages versus the old situation of Russian gas.
And then generally, what other risks could potentially affect German industrial corporates over the next couple of years?
So there's a couple of things that come to mind from a credit perspective. Obviously, the higher interest rates in the economy are starting to hit some German corporates and corporates in general more acutely. If you think about refinancing, so some of those companies will have to go out to the financial market, the capital market, and refinance themselves at higher rates. And considering that the profits, the earnings, and the cash flows are lower due to the factors that we just went through during the webinar, they will have higher leverage, so higher credit risk. The overall there is a higher credit risk in the economy, and in particular the chemical sector. So some investors might not be inclined to lend as much or in the same terms as before the pandemic and before the war in Ukraine. So there's a lot of things that have changed, and as those companies come to the market to seek refinancing, they might actually have a very different, get a very different message and be only able to borrow at very different terms. So that's one risk for that's coming in the next couple of years, is the refinancing risk.
I'll just pause for a second. I invite in the audience to submit questions. Okay, so I think then we'll close the session here. We'll send you the slides, and please see our research published today on our website, Medium-Term Energy Challenges in the German Manufacturing Sector. So just to say thank you, until next time.